Hi, everyone. This is Paula Harris, and today I have Brad Paramore, CPA, with me today. How you doing, Brad?
I'm doing well. Hope you are.
Good, yes. Wonderful Monday here. Thank you for making time to talk with me. I know you're a busy guy.
It has been a busy summer, but I appreciate the opportunity.
Well, you're welcome. I just wanted to let people know we talked a couple of years ago about the tax laws, and that's sort of what we're going to talk about today, just how they've affected dentistry. You know, Brad, you've been doing this about as long as I have, about 20 years, and you're in Birmingham, Alabama, and one of the things I know about you is you really specialize in dental for accounting practices, helping the dentist out. So how did you get into this? Anything you want to say about your background?
You know, people ask me that all the time, and so we started kind of going back, and you know, we had a traditional CPA firm, and we were just taking everybody that breathed and those type of things, and
right.
At some point we just kind of started looking at our practice, and it's like, who do we enjoy working with the most? And we had about 5 or 6 dental offices, and we really liked those dentists and everything, so we kind of started kicking the tires from that side, and we got involved with something called the Institute of Dental CPAs nationally, and MD Tax Network and everything, and it just kind of blossomed from there.
Well, you know what?
Today we work with about 125 dental practices across the Southeast.
Wow, so it's not just Alabama. You're in the Southeast, right?
That's it, yeah. Well, I'm spending a lot of time up in Tennessee and Georgia right now.
That's great. So what you did is kind of what we talk about with dental practices with the 80-20 analysis, and you looked at your top 20% and found your niche. Is that right?
That's it. I don't know if it was the top 20% at that point that mathematically did, but that's the ones we wanted to go work with. So
there you go.
It worked out well.
That's right. There's an emotional top 20 and a financial top 20%. So
That's right. So
yeah, I get that. Well, last time we talked about the new tax laws affecting dentistry. That was a couple of years ago, and some things have changed, and I wanted you to give an update to the doctors about what you see happening. So take it and share with us what you see.
Okay, that sounds good. Yeah, I believe it was about 2 years ago when the new law had just been written, and between then and now, it's been, the Congress has written the rules, the IRS has written the rules, how they're going to regulate what Congress had said and everything. So it may look a little different or a lot different from what we talked about, what we were anticipating. So basically, the biggest thing I always look at when we're talking to people, because of the questions we get, though, is how much difference did it make for me? Kind of thing. So I've kind of got an example where I ran some numbers. If I made, after my deductions, about $200,000, and I run that through a software, and I compare it to the previous tax laws and the new tax law, I would have saved about $6,000. So it's about a 3% savings across the board that way, and it comes out, it works in different scenarios. Now, as my income gets a lot higher, I may save a little more and those kind of things, and there's some deductions and stuff that really help us get to that we'll talk about a little later, but just apples to apples savings, probably about 3% on the percentages.
Wow, that's great. 3%. That's anything helps.
Yes. Now, the problem is, though, they took away some deductions, so we may be doing 3% of a different number kind of thing, but, all in all, what we're seeing, especially in the dental world, most people are coming out well. Most of us came out better than we would have in the prior year, but maybe not as good as some other industries, because there's a couple of deductions and stuff that they excluded us in, and we'll talk about those here in a minute, too.
Okay.
But as an overall, I think it was a good plan. Now, what we're seeing and what we saw this tax season, and what probably most of the people listening saw, is their tax refunds or they owed more and those type of things, the people that work for them were coming saying, hey, I owed money this time for the first time ever.
Oh.
And so what happened was the IRS or the government in their infinite wisdom decided to change all the withholding tables to give everybody all this savings that they were going to have in the new tax law. And they basically miscalculated. So, so when I'm comparing apples to apples to a client, I'm looking and I'm saying you had $6,000 less withheld than you did the prior year on your tax return. So your income was the same, and you came out where you owed $1,000, but your withholding was $6,000 less. So you really came out good. It just doesn't show that. So
I see.
So what we say, and I stole this from somebody else, and I can't remember who said it, though. They said it was a great tax plan. It was the worst rollout in the history of tax plans, so and I think that's what we're seeing in most of them. So.
Oh, right. Okay. Oh, man. So that's interesting, but it still sounds good news.
Yeah, and all in all, it is still good news, and it's funny. I was at a tax conference last week in Chicago, and they were already talking about taking advantage of all these laws before they roll out in 2026. And I'm like, wow, we're just now getting used to them being here. I hadn't even thought that far down the road. So,
wow.
But the laws are set to roll back to all the old tax rates and everything in 2026. That's just how it was written.
Oh, okay. I didn't know that.
Yeah,
okay.
Most people don't, and it's the plan is when they do that type of stuff is we'll extend it later and everything. But if there's different people in control, that may not happen. So
that's true.
So the biggest changes that we saw that are affecting our dentist is there's actually two, and two of the largest ones anyway. One is the new 20% deduction for domestic production. What's happening here is basically the corporate tax laws went to 21%. So Walmart, all the big companies who are C corporations went to 21%. The brackets for individuals went to a top rate of 37%. So what they were trying to do is they were trying to put us on the same level as the C corporations or the big corporations. So they gave us what would they call a 20% pass-through deduction for qualified business income.
Okay.
It's Section 199A, if anybody heard anybody talk about that. This is where we really are making our most of our planning strategies and stuff. Because what they did was, it's a great tax law, great deduction, because basically if I make $100,000, I only have to pay tax on $80,000 now.
Oh, okay.
The problem is somebody came in and decided, hey, we don't like service companies getting this deduction.
Oh.
And service companies include dentists, consultants, and accountants. So everybody on this call, that's us. Well, through the negotiations and everything, they decided to put an income limit in there. So if you are a dentist that is married and you make, after deductions, $321,000 or less, or $160,000 or less for a single, you get this deduction. You get 20% deduction on all your income from the company.
Oh, okay.
If you go above those limits, it starts phasing out, and then once you go over $421 for a married and $210 for a single, you don't get any of it anymore.
I see. Now, is that $321 gross or net?
That's net. That's after everything. That's all your deductions and income and everything.
Gotcha. Okay.
So this is our sweet spot right here. This is where we can really make a difference, because if we do the planning right and we look and you're sitting at $400,000, we start looking at what equipment you might need.
Yeah.
Because if you were going to buy a piece of equipment anyway, why don't we go ahead and take it, get you below that threshold, and get that deduction?
Yeah.
So we're running a what-if scenario. It's if I buy this equipment, or if I say equipment, but the other expenses we're looking at is retirement plan contributions. If I put this into a retirement contribution, it may take me below this level. We can actually prepay rent and do some other things too, but those are the things that we're really looking at to try to get us below. Now, some people are going to be above that number. We're not going to get there, so this is not going to affect them. Some are startups 2 to 3 years under that level, and it's not going to matter. But there are a lot of people that are right in there in that threshold. So it's been a great opportunity. We were able to get a lot of our people under that last year, like I said, just by buying some equipment, going ahead and doing something in December that they were going to do in January, February anyway, and taking advantage of that.
Okay. Great. Sounds like a good plan there. I'm sure the supply reps are very happy about that.
Oh yeah, they'll tout that. I always say the supply reps knew Section 179 depreciation better than the accountants.
Oh yeah,
because they always wanted you to buy that, buy this, buy this, buy this.
Yeah.
Now, one of my big philosophies is I'll never tell you to spend $1 to save 40 cents.
Yeah.
We basically don't want to do something just because we can deduct it. But in this scenario, if that's going to get me below to get another 20%, I may be spending $1 to save more, but we're really still just looking at what was I going to do anyway.
Yeah, right. Okay, that makes sense. All right.
Now, as part of this deduction, one thing that went away that a lot of dentists took advantage of is there was a manufacturer's credit for doing crowns in-house and those kind of things.
Oh, yeah.
That did go away. Yeah. So that is no longer in the tax law. So we don't do that. To be honest with you, the calculation of that was so meticulous and everything that probably I'd say we had about 20% of the people that once we did calculation really benefited from that.
Yeah. Okay. So that's like your...
And they had to mill their own crowns and anything and everything anyway.
That's like your CRX, E4Ds, things like that.
Right. Most definitely.
Okay. All right.
And then I guess what kind of goes along with that is the other big change was the change in the depreciation rules.
Oh, okay.
Historically, we could take Section 179 on assets, and for most dentists, it's kind of qualified, but you could do up to $1 million and write it off. But the way the new tax laws read, and with bonus depreciation, that's basically unlimited now. We can write off everything from equipment, those type things. Now, if it's a building or building improvements, those type things, it doesn't qualify as much. We can do what we call a cost segregation study and kind of allocate some. But for the most part, any equipment, computers, office supplies, those type things, you're going to be able to write off no matter what.
Okay. That's good news.
And that helps us, again, if we're trying to get back to that other side, trying to get to below that 20% to get that 20% deduction.
Right. That makes sense.
Really does.
Oh,
now,
awesome.
let me say this, because this is something we do here a lot, is especially with startups and everything, they may not need all that depreciation because they're starting up. They're probably in a lower bracket now than they will be in 3 years. So we do a lot of calculations trying to save some of that. So we don't have to take bonus depreciation. We may want to depreciate that over a 7 or a 5 year life, so that the dentist is getting the benefit for it. Because again, if I'm starting out and I start out in October, I'm probably not going to have a lot of income that's going to hit my tax return that year unless I had a W-2 from a previous job and everything. So why do I want to, take all my depreciation and get to zero this year, yeah, you get a big refund this year, but that's not wise year 2, year 3, year 4. So we always try to look at the long-term picture when we're looking at that.
Well, that makes sense. Good idea. You can spread it out like that.
Yeah. So.
Okay.
And we typically don't have to make those decisions until we are actually filing the return. So what we will do is we'll run a what-if scenario. So, hey, what if we did this? Okay, well, we don't need that much depreciation, and then we'll go work it again and say, how about, let's capitalize this asset, and, so it works out pretty good.
Oh, that's good. You can kind of do a trial run and see what's going to
happen.
Right,
that's right.
Gotcha. Okay.
So the third thing that we're seeing most of the changes in was the changes in the fringe benefits and the entertainment expenses and stuff.
Okay.
So I guess the big thing was the repeal of the entertainment expense. So historically, if you took a client or a patient to a football game or to a theater, we could deduct 50% of those expenses, and they did away with those. So those are no longer deductible.
Oh, that's a bummer.
Yeah. So what we have to do though is we kind of look at the scenarios of, all right, if I was going to go play in a golf tournament that was for some charity, as opposed to me paying to play in that tournament, I may do an advertisement and sponsor a hole.
Oh.
That makes it advertising instead of entertainment.
Gotcha.
So we just have to think a little differently along those things. We want to take the same dollars we're spending or going to spend and, take the best tax advantage of it. Now, the ball game tickets and those type things, we haven't found a loophole for that yet. That's just, we're losing that deduction as it is. It doesn't matter who you take with you or whatever. Those are, and most of our dental offices would have small ones. We're seeing that really in bigger corporations. That's a lot bigger thing because they would get those corporate boxes and stuff, and so they're losing a lot more than we are. So so I guess that's the plus for us anyway. So.
Oh well.
And the other side too is historically there was two types of meals in a dental office, in my office and yours, Paula, where if I brought in food so my staff could eat and continue to work, we would call that staff meals, and that would be 100% deductible.
Okay.
Well, the new tax law did away with that. So basically, those meals are now treated the same as the meals and entertainment when we went out, which is 50% deductible.
Oh, bummer.
Yes. That was one that we really pushed hard and we really liked and used a lot, and they did away with that. So so what we're basically looking at on that side is if we can hold meetings, do educational meetings and those type things, and allocate it more towards a education thing than just feeding them so they'll stay and work.
Right.
And those type things. That's where we're trying to get that under meetings cost as opposed to meals.
Okay. All right. So that would go under meetings instead of meals. Gotcha.
Yes. And that may be where we bring in a speaker, a rep, maybe supply rep to come in, go over something that they need to go over, and those type things.
Oh, okay. So that's like what I do when I go on site.
Right.
Yeah.
Most definitely.
Okay. Okay. Perfect. All right.
And then the other thing that's more for associates and everything than it is for a dental practice owner, but we kind of talk about this because we think that if we can help keep that associate happy, we may can keep them longer type thing.
Right.
Is one of the big things in the tax law was they did away with employee business expense deductions for W-2'd employees.
Oh.
So if you're a W-2'd employee, you can no longer deduct your mileage or, licenses, any of those type things.
Okay.
So what we're doing is we're kind of looking at the package from our dental practice side and saying, okay, is there a way we can build this into their compensation? Because I can deduct it. If you turn in an expense report to me for mileage that you drove, not commuting miles, but maybe between locations if you've got multiple locations, or your licensing, if I reimburse you for that in cell phone, because all associates have to be on call, if I could reimburse you for that as opposed to you having to pay it, I can deduct it, and so we can get the deduction. Now, of course, we want to lower what we're paying them based on that formula. So it's kind of one of those things where we have to work and see what would that formula be. If we're paying 30%, does that mean 29%? How does that work? That's kind of something we're working through on an individual by individual basis right now to see where that happy spot is.
Oh, okay. Yeah, that's a good point. Yeah, so that brings up a point I recommend all the time is give your employees a package review, not just what they make hourly. They tend to look at their stub, and I'm like, at least once a year, give them a total package review of everything that's included.
Right. Most definitely. Definitely.
Okay.
Because again, if I can do something as an after-tax dollar to my employee, that's going to make them happier. They're going to end up with more. I still get to deduct it as a business expense on my side, so it doesn't cost me anything from that side.
Yeah, gotcha. That makes sense. Good point. Okay.
All right. One of the other things that we always look at and talk about is trying to hire family members. We always want to take the money we're giving to some kids and maybe have them do some work in the office, cleaning, cutting grass, any of those type things, emptying garbage, those type things. What ends up happening is this. If I've got my 12-year-old and he gets a $12,000 standard deduction. So if I paid him $10,000 on a W-2, I deduct the $10,000 on my practice plus the Social Security and all that, and then he files a tax return. He doesn't owe any tax because of that $12,000 standard deduction. I got to deduct the payments that we pay to him. He doesn't pay tax on it, so it's another way to get a tax write-off.
Oh, cool.
So what we're doing is we typically are trying to take some money and maybe we put that money into an education account. Some kids just think they're helping mom and dad out. They don't really know that they're working. So, we don't want them to know they're getting this money, but we're putting it in a savings account for them type thing.
Yeah.
The other thing is, if we're in a situation where we could fund a Roth IRA for the kids with their earned income, as long as they make that money, they could put $5,000 into a Roth IRA, and if they do that for a few years, that's really going to build up. There was one guy that ran the numbers of what that would be when they hit 65. Because it's tax free because it grows tax free. But I'm like, there's no kid going to not cash that in by the time they're 24, 25 anyway. So.
Yeah, school loans.
Yeah. So, but there's things they can do with it and not pay a penalty. If they use it for education and those kind of things too. So, but the big thing for us is helping our clients get that deduction for money that they were going to be paying for those kids anyway for different things. And again, we have to have we have to structure the work, and the pay needs to be appropriate for what they're doing. So we need to justify what they're doing and those type things.
Yeah, that's interesting you say that. My father owned his own business and hired me at age 12. Same thing. Started paying me, and I just turned that magic number last week. So, I get a statement of what it's going to pay me. I think I'm going to wait a little while because it's more if I wait. But yeah, so that was
most definitely
smart move for my father. Yeah.
Yeah. I mean, that's just a way, again, when you look at the income tax rates and everything, we just want to be smart with the assets that we've got and allocate them the way we should. So
yeah, absolutely. Well, that's great. That's awesome. Good advice here, and just some twists and turns. Yeah. Mm-hmm.
The other thing on hiring family members too is the spouse.
Yeah.
And the reason we really do that, because it really typically will flow through to the same tax return. But what we want to do is make sure that we can take advantage of the retirement plan contributions for the spouse and the doctor.
Right.
So, again, we have to justify what they're doing and those type things. And a lot of them, if they have full-time jobs, it may be hard to justify certain amounts, but that's just something we look at for everybody.
Oh, I gotcha. Okay.
So.
Yeah, that makes sense. All right, good point.
The other big thing we're looking at now is with the new tax laws, we've been through a tax season with them. We've seen some loopholes, and so one of the, I didn't say this back when we were talking about the 20% deduction, but the regulations from the IRS literally came down on the end of March in 2019.
Yeah.
On how to calculate that.
Wow.
That was probably one of the largest discussions that we had in our business. Everybody was, hey, how are you calculating this? And those types. That went back and forth so much over the year and a half after the law was released, and when they actually told us how they're going to police the law. So.
Wow.
But one of the things we are looking at with everybody is we just want to review our entity. I may be an S corporation, and that may have been great under the old tax law. Is that still best for me in the new tax law? I'm an LLC. Is that still the best for me? Those type things. We're looking at C corporations some, but I doubt we're going to see any dentist that we're going to suggest a C corporation to. Okay. But there is a scenario where that might come up. Under the old tax law, there was a thing called personal service corporation, where any service, you, me, dentist, we got taxed at the highest corporate rate for every dollar. So no service corporations were ever C corporations because of that. That is gone now. So we may see a C corporation pop back up in the dental practices. I doubt we're going to see it in our smaller single practice, but we may in some of our largers. It may work out to where that is a better scenario or a better way to look at it, or a better way to run the numbers. So that's something we see. But we're just reviewing. Again, it's just, let's go back in and look at the entity. Why am I this? If I was another type of entity, how much tax would I be paying? Yeah. Would I get some extra deductions? Those type things. We're just kind of, in our mid-year review, we're wanting to review this because let's just say I run the numbers and I think Paula should be an S corporation, even though she's been an LLC.
Yeah.
I really can't make that change until January anyway. So for 2019, you're still going to be under your old rules. And then I would make that change for 2020, and forward. So.
Okay, that makes sense. All right.
Okay, and then the other part of this, kind of in that same realm, is we're reviewing everybody's retirement plans. Okay. Just because I put in a 401k, 10 years ago, doesn't mean that the 401k is the best for me right now. So we're just kind of running the numbers again. Is this the best for me? Yeah. We've got defined contribution plans, defined benefit plans. We've got 401k plans, simple IRAs, those type things. We're just running the scenarios to see where, so especially if you're over that $400,000 realm, we're wanting to make sure we can put as much as we can because in most scenarios, we're saving 37% federal, and probably 5 to 6 state, depending on what state. some people in Tennessee, I guess, have no state tax, but
hallelujah.
We did. I know. That's one plus, huh?
Mm-hmm.
So but we want to just maximize the dollars that we want to do. So if I can take that deduction and save, let's say 43% in tax, and then it'll grow tax free until we take it out. And the theory is, historically the theory's been I'll be in a lower tax bracket when I retire than I am now.
Right.
If you read the right blogs and those type of things, they say our tax rates are going to be so high then. So, if I could read the future, I would not be learning tax stuff and everything. I'd be sitting on a beach somewhere. So, the theory is right now the time value of money. I'd rather have that dollar now in tax savings to invest in my business or whatever, and defer the tax for later. So.
Okay. All right. Makes sense.
And then, from a standpoint of tax savings and those type of things, those were the major changes we saw and the major things that we're looking at. One of the things we are doing, going back through that I'll run through real quick. Are we good on time?
Yeah, we got a couple more minutes. Yeah.
Okay. Okay. Well, a couple of things we're just reminding everybody of is some of the stuff that has come up in some audits and everything. And so I just got a list of about 10 things that we just kind of, run through real quick.
Okay.
Annual meetings of, for your business. We really need those. We need those on file. I know nobody does on those kind of things, but that is something that we really do need to kind of, and most of us have these meetings, we just don't document them. So those type of things. Receipts. This has come up in the last year more than it's kind of surprised me. We really need everybody to scan and store their receipts for any expense we take. Credit card and bank statements do not qualify as a receipt. I had this come up the other day, and we're seeing a lot more audits in the sales tax world, so it's state and local, that want to look at a hard receipt and see that I paid sales tax when I bought this book or those type things, or a piece of equipment that we buy online and those type things. So basically, we just need a system of storing your receipts that back up all of our expenses that we take. We need some kind of loan documents between the doctors and their practices. A lot of times there will be a due to, due from, and those type of things. The IRS is starting to want to see copies of notes. So we've got a little generic note that we just draw up and sign and put in the paper, the file that says, I owe the practice $10,000 or the practice owes me $10,000, that kind of thing. It's pretty simple. It's nothing rocket science or anything, but that is something that we're seeing come up now. Okay. I get asked all the time, how long do I need to keep receipts? We typically say 5 to 7 years for everything. They can really audit you for 3 years, but so we usually at least do 5 years to be safe on everything.
Okay.
Let's see, signed agreements, that's nothing. Let's see. Any kind of agreement that we have between the practice and us personally, as far as rent, we're rent a building and those type of things. 9 times out of 10, we're doing those on a verbal lease and stuff. They're starting to ask, I want to see a written lease and those type of things. So that's again, that's something you can really Google and get a cheap version real quick and just put in a file somewhere. Okay.
Okay.
But that's it. The main thing on all these are really just, tracking your expenses and documenting them. Okay. Mileage for, going to the business offices and going to events and going to, CE events, those type of things. We just, need people to keep a better track of the miles that they do.
Okay. All right. There are apps for all this too now.
Yes, like on the mileage side, we're using Mile IQ, is very good. I've got a lot of people that are using that, but there are several others that are doing that.
Okay. Mm-hmm.
And there's a lot of apps that we're starting to use that will scan receipts.
Yes.
And store them electronically. And we're using something called Receipt Bank a lot, where we'll take a picture of a receipt and it'll send it to QuickBooks.
Oh, okay. Mm-hmm.
And it memorizes that a certain restaurant goes to Meals and Entertainment, or those type things.
Sure. Okay. Mm-hmm.
So.
All right, that's cool.
But those are the biggest changes we're seeing. Like I said, we're doing a lot of planning to take advantage of most of these tax laws. You really need to know where you are now. So, we need to be looking at numbers that, show, hey, for the first 6 months, this is what my income was. And if we finish out, like we did last year, I'm going to end up with this much in taxable income. And what can I do, kind of thing. And we start looking at these different scenarios of what kind of equipment do you need? Are you looking to expand? Are you, are you looking to do any kind of construction? Those type things.
Mm-hmm. That's good. That's good. Yeah, it's a good idea. I do 6-month checkups with my clients as well, looking at their numbers, production, measuring a lot of different things, key indicators. And so good idea to look at this as well. Look at their overhead, look at their P&Ls, and review this with their CPA.
Yeah, I like to tell our doctors that this is when we dig like this, it's like getting an X-ray. You can see so much more when you get it all in front of you.
Yes.
That it not only answers questions that we have, it brings up questions that we didn't have, kind of thing.
Yes. Yeah, I always say the numbers tell a story. There's a story in here. We need to figure out what's going on. That's right. Okay. That makes sense. Well, this is great advice, Brad. Thank you so much for sharing all this with us. Good information. And anything else you want to share before you go?
No, I mean, again, we are a CPA firm in Birmingham. We cover the whole region. We were spending a lot of time throughout the state and over in Georgia and Tennessee these days. And so what we're trying to do is we've got a model that we built for dental practices, and we're trying to just help as many dentists as we can. So we'd love to talk to anybody. We'd love to, give a free assessment when we, look at it and kind of talk through to see if there's ways we can help, those type things. Okay. My contact information, I think, will it be available on the web, or you want me to give it to you?
Yes, go ahead and give it to me.
Okay.
I'll put it in there, but let's hear
okay.
it. Yeah.
But my direct line, my phone number is 205-733-8265.
Okay.
And our website is ttpcpa.com.
Okay.
And then all our information will be there from the emails and those type of things. But love to talk to anybody. If you've just got some questions and those type of things, I'd be glad to talk to you for a few minutes on those.
Okay, great. Thank you for sharing that. Let me ask you one quick question before we go. You also help with practice evaluations and transitions. Is that correct?
Yes. What we do is basically we do a lot down at the dental school, so we've had people going out and buying practices and those type things.
Yeah.
So what we basically do is we have a little system where we'll sit down with someone who is buying a practice, and we work through the numbers. So we typically will get three years worth and cash flow it. We can do the valuations to see what the practices would be worth and those type of things, and what the financial, what we would have to borrow, the debt service, and run a cash flow model to see, can I afford to buy this kind of thing.
Right.
But yeah, we do that. We typically, to be honest with you, we've got about 4 acquisitions going on at all times.
Wow.
We're, I'll be meeting with someone tonight that's looking at buying one. So that's fun. Now, on the seller side, our clients, we've got the data because we've got their financials in good shape where we're able to forecast out, what we think we can get for the practice. We can, work and negotiate with the possible buyers and those type things and everything. So, yeah, we get to work on both sides of those.
Oh, that's great. That's great. It's so helpful because there's a lot of that going on right now, too. I've seen
it really is. Yeah. And one thing that we do, Paula, is, and you and I may have talked about this in the past, is as we're sitting and talking to our clients and get to know them, I kind of know 4 or 5 years before you're thinking about stepping down or selling or listing or whatever. Yeah. So we can kind of talk through the little things that we can do to get that value up. Yeah. Because a lot of times some people will come to us and they'll say, hey, I want to slow down at this point and then maybe sell in 5 more years. Well, if you slow down, you're giving up part of your retirement asset there. So so we kind of talk through maybe bringing an associate in, selling part of it, those type things. Yeah. Again, it's just getting the information and talking through it with them.
Yeah, gotcha. Okay, makes sense. All right, well, I just want to put that little question in there because I know a lot of people ask me for that. So
yes, that's the fun side. That's the fun part of the business is looking through acquisitions and those type things. So.
Oh yeah, I know it gets real interesting. So many scenarios and options. But well, Brad, I just want to thank you again for your commitment to dentistry and your expertise. And I hear good things from other clients who work with you. So I appreciate your time, and we'll look forward to talking with you again sometime soon.
Thank you very much for having me, and I enjoyed talking with you.
All right. Bye-bye.
Bye.